Welcome,
Okay.
everyone, to Buckhalter's podcast on the CFPB's finalization of its new rules, changing the qualified mortgage definition and creating the new seasoned qualified mortgage loan category, a very important topic for anyone involved in loan originations and loan servicing. Our speakers today are me and Melissa Richards, also a Buckhalter. Both of us are members of the firm's mortgage banking practice group and our commercial finance group. I am a former general counsel, along with Melissa, of companies in the mortgage space. So we bring a lot of expertise to this area, not only from a law firm legal perspective, but from in-house operational perspectives and risk management perspectives. I'm the former general counsel of PNC Mortgage and Flagstar Bank and the former acting general counsel of HUD. Melissa, along with being a very frequent speaker and publisher in this area, is the former chief legal and risk officer for CMG Financial, a large mortgage lender which operated in the correspondent, wholesale, and retail channels, giving Melissa a wide range of expertise in not only the legal aspects of this, but the real operational risk issues that would arise out of this type of change and this type of loan product. Let's talk a little bit about this rule and how it came about. You have to go back to the original creation of qualified mortgage definitions coming out of the last financial crisis, where they created the qualified mortgage definition to create a safe harbor in regard to the ability to repay rule. And a key component of it was a DTE ratio threshold that had to be met, that many people felt was a very strict guide requirement, sometimes difficult to get around. And the idea that the CFPB came up with was, after consultation with the industry, to modify that to create some different standards that would apply to replace the DTI requirement. And Melissa is going to start off by talking about the general qualified mortgage definitions changes and what's required now to make a qualified mortgage to take advantage of that safe harbor. Melissa?
All right. Thanks, Mike. Here we go. Next slide. All right. The CFPB issued final rules amending the general qualified mortgage loan definition in Regulation Z, and by separate rule created a new quote unquote seasoned QM loan category in Reg Z. Both these rules take effect March 1st. The general QM rule has a mandatory compliance date of July 1st, 2021. The CFPB is applying the mandatory compliance date to the date on which a creditor receives a consumer's QM loan application. And starting on the effective date, March 1st, and continuing through July 1st, compliance with the general QM final rule is optional. There are new eligibility requirements for originating general QM loans under this rule. The rule redefines what is a covered qualified mortgage transaction, and it replaces the 43% debt to income ratio limit with a price-based limit and removes the Appendix Q national underwriting standards, as well as any requirement to use Appendix Q for general QM loans. Under the new definition, a general QM loan meets all of the following criteria. First, the loan must be fixed rate, fully amortizing, and provide for regular, periodic, and substantially equal monthly payments. Or in the case of adjustable rate or step rate mortgages, the loan must be fully amortized. It must not allow for deferment of principal loan amount repayment outside of a temporary, like disaster or pandemic related national emergency. And the loan does not have a balloon payment feature unless it meets specific criteria within the QM rule. And that's found at Reg Z section 1026.4 43 sub F. The maximum loan term for general QM loan cannot exceed 30 years. And the total points and fees associated with a general QM loan generally cannot exceed 3% of the total loan amount. And that's for loans of $100,000 or higher, adjusted for inflation. The total points and fees amount can go up for smaller loan balance loans. Replacing the former 43% DTI cap, the eligible loan must now adhere to a new price-based limit, whereby the annual percentage rate does not exceed the average prime offer rate, or APOR, for a comparable transaction by a certain percentage points threshold. That threshold is 2.25 percentage points for loan amounts equal to or greater than $110,260, again, adjusted annually for inflation. For lower loan amounts, the threshold percentage increases incrementally up to 6.5 percentage points. Now, the threshold for subordinate lien covered loans is 3.5 percentage points if the loan amount is at or above $66,156. And it increases to 6.5 percentage points if the loan amount is below that $66,156. For manufactured housing, the manufactured home must meet HUD code standards in order to even be considered to be a QM loan. And for loan amounts at or above $110,260, that APOR threshold is 2.25 percentage points. Again, that threshold increases to up to 6.5 percentage points for lower balance loans. But again, stressing here that the manufactured housing must meet HUD code standards to even be eligible for QM loan treatment. If the loan's interest rate may or will change in the first 5 years, creditors are instructed to calculate APR for purposes of measuring this threshold by applying the highest potential or scheduled interest rate during the initial 5 years and assume that rate will apply for the full loan term. Replacing the former Appendix Q underwriting standards, the creditor must instead meet a Reg Z quote unquote consider and verify loan underwriting requirements. This means that the creditor must consider the consumer's current or reasonably expected income or assets other than the value of the subject dwelling, plus debt obligations, alimony, child support, and monthly debt to income ratio or residual income in order to assess the consumer's ability to repay the mortgage loan. And the creditor must verify all this information using third-party records that provide reasonably reliable evidence to support accuracy. The underwriting takes into account the monthly payment for mortgage-related obligations using both the maximum interest rate that may apply during the first 5 years and the periodic loan payments of principal and interest that will repay the loan amount over the scheduled loan term, or for adjustable rate loans, the outstanding principal balance over the remaining term of the loan as of the date the interest rate adjusts to the maximum interest rate, assuming the consumer will have made all required payments as due prior to that date. Now turning to agency loans. So loans that qualify for federally insured or guaranteed FHA, VA, and USDA or RHS mortgage loan programs will remain as covered transactions under the general QM final rule. Now for the patch. In 2013, the CFPB created a temporary qualified mortgage category for residential mortgage loans eligible for purchase by Fannie Mae or Freddie Mac while they operate under conservatorship or receivership of the Federal Housing Finance Agency. This temporary QM category was scheduled to expire no later than January 10, 2021. However, on October 20th, 2020, the CFPB extended this expiration date to align with whatever mandatory compliance date would be established in the then impending final general QM rule. The final rule gets more specific on the new expiration date for the temporary QM patch category. That category will be available only for covered transactions for which the creditor receives the consumer's application for a Fannie Mae or Freddie Mac eligible mortgage loan prior to July 1, 2021, or sooner if the GSEs exit conservatorship of FHFA at an earlier date. However, we now know that the Biden administration will not be seeking exit for Fannie and Freddie from conservatorship prior to July 1st, 2021. All right, now I'm going to turn it back over to you, Mike, to talk about QM safe harbor category and the new rebuttable presumption thresholds.
Thank you, Melissa. As I mentioned earlier, there is the whole purpose of QM is to provide a safe harbor for the meeting the ability to repay test. And under the original QM rule, there were percentage thresholds for meeting the safe harbor test versus only getting a rebuttable presumption of compliance with that requirement. And so the rule remains to be eligible for safe harbor protection. That is the conclusive presumption of meeting Reg Z's ability to repay standard. The APR on a first lien QM loan cannot exceed the average prime offer rate, APOR, for a comparable transaction by more than 1.5 percentage points. For subordinate lien QM loans, the APR cannot exceed the APOR by more than 3.5 percentage points. The participants listening to this program are probably very familiar with these requirements, and this shouldn't be too much of a problem. Now, let's talk about, before we talk about the seasoned QM loan category, let's stop for a second and think about what Melissa just explained to us in great detail. We mentioned earlier that the purpose of these changes for the general QM was to replace the DTI requirement with the price-based limitations, but with the goal of still maintaining QM as a limited and defined type of loan to receive special protections. That is still carried out in the requirements Melissa so expertly laid out, but replacing the DTI with the price-based limitation. Similarly, the CFPB decided that the risks that the QM rule were meant to address and the abilities to gain protections could also be achieved when a lender was essentially required to carry all the risk of a loan it made. It would be more careful in what it did potentially if it continued to hold the loan and bear all of the economic risk. Accordingly, for lenders that wanted to do this for loans that didn't meet the requirements that Melissa just laid out, they created the category called the seasoned QM. And it's fairly simple. To be a seasoned QM, a mortgage loan must meet loan eligibility requirements that are similar to the general QM rules with slight variation, which we'll go into And importantly, the loan must be held in the lender's portfolio for 3 years. We'll discuss how that's calculated, and meet certain performance requirements and portfolio requirements for holding the loan and the loan performance, which we'll discuss. All right. The basic requirements are very similar to what Melissa said, with the exception of the price-based limit issue. So it must be a first lien fixed rate loan with substantially equal periodic payments. And again, certain allowances for accommodations in connection with disasters or pandemic related emergencies, must be fully amortizing. Again, it must not have a balloon payment unless it meets those very limited balloon payment QM requirements exceptions under 12 CFR 1026.43F. And the loan term must not exceed 30 years. The points and fees must not exceed the QM points and limits set forth in 12 CFR 1026.4331, which, as Melissa discussed, for loans over $100,000 is 3% of total loan amount, and for loans of lesser amount, it's somewhat higher. It's not a high cost loan as defined in the rules, and the underwriting takes into account monthly payment for mortgage related obligations using the maximum interest rate that may apply during the first 5 years. So the idea being you're taking a look at the ability or the loan payments based upon an assumption of the highest loan interest rate in the first 5 years being achieved. And you must use periodic payments of principal and interest that will repay either the outstanding principal balance over the remaining term of the loan as of the date the interest rate adjusts to that maximum interest rate, assuming the consumer has made all required payments, or the loan amount over the loan term. Melissa, can we go on to the next slide? Thank you. And additionally, at or before loan consummation, the creditor must have considered the consumer's current or reasonably expected income or assets other than the value of the dwelling that secures the loan, debt obligations, alimony, child support, and monthly debt to income ratio. In other words, the standard other income or assets, using, again, as Melissa has pointed out, using reasonably reliable third-party records to verify the consumer's income or assets and their current debt obligations, alimony, and child support, again, using reasonably reliable third-party records. Now let's talk about some of the performance requirements. These are very important because of the need to hold the loan for 3 months that must perform properly under that 3-month period, or 3-year period, excuse me. Here's what's required. The loan must have no more than 2 30-day delinquencies and no delinquencies of 60 or more days during the 3-year seasoning period. There are some exceptions. If a loan is delinquent at the end of the seasoning period due to a disaster or pandemic-related national emergency, the loan may still be a seasoned QM if some conditions are met. Any temporary payment accommodation extended to a borrower under these circumstances are not counted towards the 36-month seasoning period, so you exclude them. If a loan is 30 days or more delinquent at the end of the seasoning period is not deemed to be ended until the delinquency is cured, and then you apply all the 36-month performance standards based upon that time period. And a creditor can generally accept deficient payments within a payment tolerance of $50 for up to 3 occasions during the seasoning period. So over a 36-month period that you're using, if the borrower is deficient by $50 or less 3 times or fewer, you can still consider it to have been performed. Now let's talk about some of the portfolio issues. This has to do with the seasoned QM actually being owned by the lender who made the loan, which is sort of the basis of the idea. To be a seasoned QM, the transaction at the time of consummation must not be subject to a commitment to be acquired by any other person. Additionally, legal title cannot be transferred to another person before the end of the 3-year seasoning period. There are some exceptions to these, though, that are important to note for people that do engage in those kind of transactions. There can be limited opportunities for sale, assignment, or transfer prior to the end of the seasoning period first for a creditor merger or acquisition. So creditors are not bound not to merge or engage in acquisitions because of this rule. If they have these assets on their balance sheet, they can go ahead with those kind of transactions. If it's part of a capital restoration plan or similar corrective action under bankruptcy or other similar requirements, receivership, conservatorship, order of government, or similar requirements, it can still be, you can have a transfer in those circumstances and still meet the seasoned QM rule. Finally, it may be transferred once during the 3-year period, provided the covered transaction is not securitized as part of the transfer or any other time before the end of the 3 years. This is an important criteria. You can transfer the loan to a third party once during the period, provided that third party doesn't turn around and then transfer it again during the 3-year period, and equally important, that either you or they do not securitize it as part of the transfer. If that happens, that type of transfer is allowed and it remains a seasoned QM. So that's our general discussion. We want to remind you that this program is designed to allow lenders to do QM loans and create a little more flexibility than the prior DTI cap. You have more flexibility in what you do in terms of considering and verifying income and assets and debts, but you have to meet all these other stringent requirements to make these loans work. So be careful, and I think Melissa would agree with me, be very careful as you're implementing this, as you tweak your current QM workflows, your QM policies and procedures. Make sure that you're tweaking them properly. That obviously doesn't need to be said, but it's really an important issue because I think we all think we know QM very well, and these rules are a bit different. Melissa, any final thoughts?
Yeah, a couple final thoughts. Number one, and this one is, I think, particularly big, is in the coming months now, we're going to see the investor community, Fannie Mae, Freddie, the agencies all grapple with the new underwriting standards, this consider and verify using third-party sources. It's going to be bumpy. I don't foresee there being consistency and standardization in what that underwriting standard looks like. So I encourage the lender community to be in continual dialogue through the spring with their investors on meeting whatever overlays the investors are going to impose on that standard. And, hopefully the agencies themselves will create some sense of standardization in underwriting as the base for, lenders nationwide to at least, have as a launch point and then be able to address investor overlays accordingly. My other comment is on the seasoned QM loan category. The issue of lenders that may have a captive Delaware statutory trust to purchase and hold their loans for a given period of time. Does that meet the season requirement? I caution to say yes, so long as those loans are not then, uploaded onto a securitization platform before the end of the 3 years.
I would agree, Melissa. That's a very good point. In those kind of situations, if you have that kind of Delaware trust set up, mind your P's and Q's very carefully.
That's right. All right. So if any of our listeners have questions, please reach out to Mike or myself or to the Buckhalter Law Firm generally. On the screen here is Mike's contact information, mflynn@buckhalter.com. And then next slide is my contact information, mrichards@buckhalter.com.
Thank you, everyone.
Thanks for listening.
Okay, great. Melissa, you can stop recording now.
Okay, I'm going to stop share.
Martha, there was some bad background noise at my end outside. If any part of what I was saying has too much background noise,